In this chapter, we're going to discuss plant and intangible assets. Now, when we talk about plant assets, typically we're talking about property, plant, and equipment. And so you'll see here it's talking about property, such as depreciations and equipment, versus land. So while property is depreciable, meaning it can be used up, land is not subject to depreciation since it's not going to disappear and should not be depreciated. We're also, as we talk about these assets, we're going to talk about intangible assets, things like patents, copyrights, trademarks, franchises, and goodwills. They have no physical qualities, but they are uniquely valuable to the firm. And the third type is natural resources. And this is a little bit different still, in that they include assets like timber, oil, minerals, other things that might be extracted or produced from natural resources. Now, when we talk about these events for any of these plant assets, we're talking about the costs or the accountable events associated with the acquisition. And then as we use it up, allocation of that acquisition cost to expense as it used up over time, with the exception of land because it's not depreciable, of course. And finally, the final disposition, be it a sale or disposal in some other way. So as we acquire plant assets, we want to include all expenditures that are ready to that are necessary and reasonable to get it to its intended use and ready for operation. And that might include the original acquisition costs, any sales tax, any delivery costs, and any installation costs. And these can be substantial, and so are included in the original cost. And of course, we use historical cost here. And acquisition costs, so we're going to talk about only those that are reasonable and necessary. So assume that a machine is dropped and damaged while it is being unloaded. The cost of repairing this damage should be recognized as an expense of the current period. So that's an example of something that's not reasonable. You wouldn't expect when you drop it. And so that's going to be a repair. That's going to be a repair expense and not be included in the cost of the plant asset. Companies often purchase plant assets on an installment plan. And so there's going to be installment plan, meaning you're going to make payments over time, or we're going to issue a note which requires payments over time. We note that interest charges after the asset is ready are recorded as interest expense, not as part of the cost of the asset. So you can't continue to capitalize that interest. But if a company constructs its own plant asset for its own use, then interest costs are included during the construction period. And so those kind of a compare and contrast there. So a factory in Mississippi orders a machine from Colorado tool manufacturer at a cost of $10,000. Payments are going to be made 48 monthly installments of $250, and that includes $2,000 of interest charge. So we look down here and see the accumulated price, and there's nothing there for the $2,000 interest charge, right? Sales tax $600, there it is. Freight charges $1,350, and then installation and setup is included there as well for a cost of $500. And so all of those would be included in the machinery account. Now, as you recall, land is not depreciable, but land is purchased and all incidental costs for get it ready for its intended use should be included. There's often real estate broker fees. There's escrow fees, any legal fees. There might be some title insurance they're going to purchase, any delinquent taxes that need to be paid, and then any fees for surveying, maintaining, finding property lines, draining, clearing, and grading the property, all are included in the cost of land. And so those are all included in the land asset. Sometimes land is purchased as a building site, already has a building on it, and we're not going to use that building. And so in this case, the only useful asset being acquired is the land. And so if we need to tear down a building, the cost of tearing down that building would be included in the purchase price, kind of getting land ready for its use. Separable from that is land improvements. And the difference between land and land improvements is land is not depreciable. Land improvements are depreciable, and for this reason, they're kept in separate accounts. These might include fairly substantial costs like cement, Driveways, fences, parking lots, landscaping, sprinkler systems are all regarded as land improvements, and they'll have a useful life and they'll be depreciated as they're used up. Now, buildings are sometimes purchased, and we might need to purchase it and remodel it to get it ready for its use. And any costs associated with that to get it ready for its intended use will be included in buildings. But after the building is put in use, any repairs are no longer included in the asset of buildings, but rather would be a maintenance or repair expense. Equipment, again, all to get it ready for its intended use, including sales tax, delivery costs, costs of getting the equipment installed in good operating order, would all be included. But once the equipment has been placed in operation, any subsequent costs, interest, repair expense, insurance, property taxes, are a current period expense and are no longer kind of categorized as an asset. Sometimes you're going to buy a building and land and equipment all for a price, and maybe you negotiate and got a better price for it because you're going to buy it all at one time. So because these land and buildings and equipment are all accounted for separately and have different depreciation, useful lives, land, of course, no depreciation, but buildings might last 30 years and equipment maybe 5 years, then we need to allocate the cost to each of those. And so there's a process to go through to allocate this lump sum purchase. And so, for example, Exercise for Health purchases a complete fitness center, and they purchase the entire facility at a reduced price of $800,000. But an appraiser comes in and says, hey, if we were to buy these separately, they would be worth $1 million. And so we're going to allocate this based on the value per appraisal, get the percent, multiply it by the $800,000 to get the allocated cost for each of land improvements, building, and equipment. And so that would be how we would allocate the lump sum. And so as we allocate that, we paid $800,000, that's a credit, and the debit would be to land improvements, building, and equipment for our allocated costs that we have computed. So you can see that included there for the purchase. Okay, so you've been hired as a manager of the new Golden Health Spas facility. One of your responsibilities as manager is to show that the facility is profitable. That's often something that managers have to manage, right? They want you to be successful. So your contract specifies a bonus if the profits are at least 10% above the budgeted amount each year. In a recent conversation with the appraiser, it became clear to you that some of the items classified as land in the appraisal were really building improvements. No one at Exercise for Health is aware of the misclassification. As a result, the appraised value for the building asset should be $350 instead of $300. So when budget profits are computed, a charge for depreciation on the building is deducted in determining the amount of profit. So the question is, what impact does it have and what shall you do? This may not be the manager's job, to go and allocate that, but it's certainly going to have a different impact because building is going to have a depreciation charge or depreciation expense. Land does not. And so that's certainly going to affect your ability to achieve that bonus based on that difference. And so this would be something that should be brought up. Truth is truth. I mean, if others agree, and the accountant, if the CFO agree that these should be regarded as building improvements, I think truth should be truth and should be determined. But the ethics are often not completely clear of exactly what should be done, but various items should be included, and probably not just to achieve your bonus, but to reflect truth. There is a difference between capital expenditures, sometimes called CapEx. Capital expenditures are usually for things like property, plant, and equipment. And these are items recorded in the asset accounts. And those are a lot of the things we just talked about in terms of plant assets. That is purchased, and then as it used up, it's going to be depreciated over a time period. There are also revenue expenditures or expenses, and these typically benefit only the current period. So the difference is that revenue expenditures only affect the current period, or it's not material. And the capital expenditures benefit many, and it is a material meaning big enough to make a difference, big enough to take the accountant's time and effort to account for it correctly. So the depreciation process allows us to allocate the use or the cost of a tangible plant asset over time as the benefits are received. And so we're going to purchase the cost. That's what we've just been talking about in terms of plant assets. Be recorded as plant and equipment. And as the services are received, as we use it up, we will allocate those costs to a depreciation expense. So depreciation expense, we need to talk about various terms. So the book value would mean the net amount that is on the balance sheet. And so we're going to have cost less any accumulated depreciation to date. So we had a 30-year building and we've used it now for 10 years. We want to reflect the net amount or the book value. And I think of the book as the accountant, right? That's what's going to be referred to as the company's books. We have this accumulated depreciation and it continues to tally up depreciation or the use of the asset over time. And it just continues to tally up. And it's a contra, meaning it reduces the cost to determine book value. Well, how does depreciation occur? Either physical deterioration, meaning it's used up, it's been weathered, it's been used, and might ultimately need to be placed, or it's just no longer useful, it's obsolete, we need to upgrade. There are multiple methods for computing depreciation. Generally accepted accounting principles require only that a depreciation method be rational and systematic. So it doesn't tell us exactly what method needs to be used, but it says it needs to be reasonable, rational, systematic allocation of cost over time. And so the straight line method is the most commonly used. That allocates depreciation expense evenly over the asset's expected useful life. There are other forms of depreciation, and these other forms include accelerated depreciation methods, like you might see for tax purposes. And so you can kind of see what this looks like. Depreciation under a straight line method is equal each period, and it's over time. Whereas the accelerated method says, hey, we're going to take additional expense up front. Both of them are justifiable. Both of them are reasonable, rational, and systematic. The accelerated method suggests, and for example, if I have a new car, I'm getting more use for it at the beginning when I know it's not going to break down than I do 5 years from now. And so there might be some rationale for why it might be worth more in early periods. So if we're going to use a straight line depreciation as an example here, S&G Wholesale Grocery acquires a truck for $17,000 and it has an estimated salvage or residual value of $2,000. That says even when the truck is used up, it's going to be worth it to someone to pay $2,000, maybe for the tires, maybe for the metal, maybe it still has functional parts. We expect that will last for 5 years. And so we're going to take and get the cost less the residual value, and we call that the depreciable base. We'll take that depreciable base and divide by 5 years, and that'll be $3,000 per year. And so we can see what this might look like over time. We've got 5 years. We're taking a fifth each year, 1 over 5. 1/5 of 15,000 is 3,000. We can see this accumulated depreciation, 3, and then plus 3 would be 6, and then plus 3, 9, 12, and 15. And we see the net book value. So what do we start at? We started at 17,000 less accumulated depreciation, and we're going to work all the way through this. And then at the end, it's still going to be worth or have a residual value of $2,000. And that's what we would expect. So $3,000 per year for each of 5 years. Now, what happens if it is for a fractional period? Rarely do we buy something in the beginning of the year and on January 1st and use it up. So what happens? Well, there are a lot of possibilities, right? We want it to be rational and systematic. And so some might be used would be round to the nearest whole month. Okay, so first 15 days of the month, include the whole month. Hey, last 15 days, maybe it goes into the next month. Or you can record 1 year, half year's depreciation on all assets. Just, hey, if we bought it at any time within a year, we're going to take a half year worth of depreciation. So let's see how that half year convention would work for S&G Wholesale Grocery. So they use straight line, but they have a half year convention. And that half year convention says, regardless of when it was purchased during the year, we're going to take a half year depreciation. So its first year, it's going to take a half a year versus the depreciation. So if it's 3,000 for a full year, it'd be 1,500 for a half year. And so you can see how that works. Years 2 through 5 look the same, but then in year 6, we have that last portion, that last 1,500 to get to the full depreciation. So you can kind of see how that would look different. Here's another example using the half-year convention. Assume that an insurance company purchases hundreds of desktop computers at a cost of $600,000. There's no residual value over 3 years. So if a full year were $200,000, if we're going to take a half each year, then it would just be $100,000 worth of depreciation. So you can see how that looks there. The declining balance method suggests that we take, it's an accelerated method, and it suggests we take more depreciation up front. And so it's a declining balance. And so as we go down, we're taking 200% of a declining balance. And, just kind of FYI, it can be 150%, or it could be 250% of the straight line depreciation rate. But in this case, we're going to just talk about the double declining balance method. That's 200% of the straight line method. And so look and see how this works here. We have the same asset as we've been talking about before, 17,000, residual value of 2,000. And so what we're going to do is we're going to take and have a declining balance each year. Now, the first thing you're going to notice, we start with the 17,000 instead of the 15,000. But we're going to take this 17,000 and multiply by double the declining balance rate. So if it's 1/5, 20% times 2 would be 40%. And so we're going to take this amount of depreciation the first year. All right. Then we have the book value of 10,200. All right. So 10,200 times double the straight line method rate, 40%. And we kind of continue to work through. Then we get 6,120 times 40%. And then we get 3,672 times 40%. The one deal about this is you can't go below the residual value. And so even though this last year, the remaining amount to be depreciated would be 2,203 less 2,000 or $203. And that'll get us down to our residual value. So you can see how that would work here. Which depreciation methods are used most? Well, most will use the straight line method for their financial statements. That's less expense. Less expense means it appears to be more income. Okay, but for income tax purposes, allowed is an accelerated method. And so as you go to tax classes and learn more about it, typically a double declining or something very similar to double declining called MAKRS would be used on income tax returns. So financial statement disclosures, estimates of useful life. So a company needs to disclose in their financial statements what useful lives they're assuming, how many years for a building, how many years for equipment. And these include estimates. I mean, we're kind of guessing. We have a piece of equipment and we're saying how many years do we expect it will last. And the auditors will walk in and say, opine about whether this is reasonable or not. But they really want a consistency. You remember, systematic, rational method. And so they're going to monitor that that makes sense. And we want that consistency to be over time. And so not changing methods, not necessarily changing useful lives unless we're certain that they're going to last longer or shorter than originally anticipated. So we're going to look at that. All right, what should be done, if any, after a few years of using a plan asset? Management decides that an asset is actually going to last for a longer or shorter period. Well, in that case, we revise the estimate. We change it from that time period forward. Say originally it was going to last 5, but now it's going to last 7. And so we're going to adjust that based on that revision. And so let's see what this looks like. Assume that a company acquires a 10-year asset, 5-year useful life, so 2,000 per year. Beginning of the 4th year, we say, hey, I think it's going to last an additional 4 more years. And so now we expect the total thing to last 7 years. And so we're going to calculate depreciation expense starting the 4th year and going forward. So as we look at that, we say, okay, what was the book value at the date of the change? Okay, and what is the salvage value at the date of the change? And then we're going to divide it by the remaining useful life. So It looks like the first 3 years we took $6,000 worth of depreciation, so there was $4,000 left, and we're going to take $4,000 and divide by 4 years to get $1,000 now per year. Rather than $2,000 per year, now it's going to be $1,000, and we'll just use that going forward. We want to talk for a minute about impairment of plant assets. If the carrying amount or the book value of an asset cannot be recovered through future use or sale, the asset should be written down. So all of a sudden it's lost value. Maybe we got some specialized equipment and new technology rendered the equipment obsolete. In that case, we need to write it down. We will incur an impairment loss to write it down to what we think is its fair value. And so that would be an example of an impairment. So JCPenney had $3.3 billion worth of property and equipment, and that was 40% of the assets. Well, because of COVID, and describing text taken related to COVID, a note to JCPenney's indicates the company incurred non-cash impairment charges related to long-lived assets. So they needed to write it down. And so they had an impairment loss. And so this talks about that impairment loss and why it was needed in the future. We want to talk about another depreciation method. You'll note that straight line and our use of double decline balance is based on time. And based on time is rational and systematic, but sometimes it's going to be on units of output. So say you have a car, and the car you decide to depreciate on the basis of miles. Some years you drive more, some years you drive less, and you think that might be an appropriate method. And so when depreciation is based on units of output, more depreciation is used when the asset's more heavily used. That seems rational and systematic as a method. So let's see how this would look. Marpol's delivery truck has a cost of $35,000, salvage value of $5,000, or residual value $5,000. Assume that Marpol's management plans to retire this truck after it's been driven 60,000 miles. And so the depreciation rate per mile is 50 cents. And so depending on how much we've used, we expect it will last 60,000 miles or 50 cents depreciation per mile. And then as we have miles that we use it, we allocate that. So at the end of each year, we say, okay, how many years do we use it? Looks like we used it 17,000 miles. And 17,000 miles times 50 cents would be $8,500. And this provides a great way of matching, especially when units of output are considered as the best method for depreciation. Now, I mentioned a little earlier, most businesses use MACRS. MACRS is similar to a double declining or a declining balance. And so that's used typically in federal tax returns going forward. So let's talk now about the disposal of plant and equipment. We talked about impairment, meaning it lost some of its value, but here we're disposing. We are retired it, we are possibly going to sell it, and we're going to go and take it off our books. And so we're going to debit accumulated depreciation, we're going to credit office equipment, and that takes it off the books of both the equipment, takes it off the book for accumulated depreciation, and takes that particular asset down to zero. So it no longer has any value. All right, what happens if we dispose of it and the price we get, the amount we sell it for, is more than our value, that our book value carried on the books? So let's look at this example. Assume machinery costs $10,000. Here it is. We had taken $8,000 depreciation to date. So its book value at the time of disposal was $2,000. And someone's willing to pay us $3,000 for that. So we actually gained some money. We got $3,000. We thought it was worth $2,000. So we have a gain on disposal of $1,000. And when I look at this gain, I think of it as similar to a revenue or income account, which is a credit. And so you can see each of these numbers included here. We got cash of $3,000. Yep. We wrote off the machinery. Usually it has a debit balance, so we're going to credit it. We debit accumulated depreciation. Usually it has a credit balance. We're going to debit it here. And the remaining amount goes in gain on disposal. You'll want to practice some of these and see what they look like, but it's pretty slick when they go through and make a journal entry. Now, what happens if it is, instead of above book value, that it's actually below book value? So same setup here, but instead of getting $3,000, we only got $1,200. So we lost $800. So similar things, we're going to take this off our books. We got $1,200, and we have a loss on disposal. And I think of a loss as an expense. Expense would be a debit. And so you can see how that works here in the case that the disposal where the price is below the book value. Sometimes we're going to want to trade used assets for new ones. So I go and trade in, the Hyundai dealer here is always trying to get me to trade in my car essentially for another one. And so what happens if I exchange a new truck costing $25,000? Exchange an old truck for a new truck costing $25,000. We get $3,500 trade-in value, and it has a book value of $2,000. Rancho pays the remaining $21,500 in cash. So let's see what that looks like. We basically have four numbers here, and let's see if we can figure out how to adjust for that. So the cost was $10,000. Accumulated depreciation was $8,000. It was on our books for $2,000. We received $3,500 fair market value in our trade-in allowance. So we had a gain on disposal of $1,500. So what did we get? Well, we got a truck for $25,000. That comes from here. We have our old truck depreciated was $8,000. Our old truck was $10,000. That's going to be taken off the books. We're paid $21,500 in cash for the new truck, and we had a gain of $1,500. And here's how that's computed there. So you can see what the journal entry would look like. International standards. Let's see how they're different or if they are. Companies have an option to follow a reevaluation process rather than continuing to use historical cost. So it's possible to go and get an estimate, go get an appraisal rather than sticking with historical costs, which would be typically US GAAP. We're going to go in and believe that it can be reliably measured. And so we'll go in and that might cause us to revalue the asset rather than just keeping historical costs. So you're going to find that US GAAP typically hinges on historical costs, whereas international standards are saying, hey, we can get a reliable estimate. And so let's use that. So you can see the differences included there. Intangible assets are things without physical substance, like a copyright, like a patent, like a trademark, like goodwill. And the valuation basis is cost. How much did it cost us to get these things? The patent, the trademark, the goodwill. For an expenditure to qualify as an intangible asset, there must be reasonable evidence of future benefits. What are you going to get out of this? Many of the expenditures offer some prospects of yielding benefits in subsequent years. Okay, so let's say a trademark. Anytime anyone looks at the Coca-Cola symbol, they say, that is Coca-Cola. And so, and you're maybe going to be willing to buy it or pay a premium for it based on that. We're going to amortize this intangible asset. So amortization is somewhat equivalent to depreciation. So you can see amortization of an intangible asset is essentially the same as depreciation for a tangible asset. It's just when we use the term amortization, we know that's for an intangible. So the usual accounting entry would be a debit to amortization expense, like depreciation expense, but rather than an accumulated amount, we're just going to go ahead and credit directly the intangible account. Although it is difficult to estimate useful life of something like a trademark, we go ahead and do that. We're trying to assess how long it will contribute to future earnings. And so we want to, that takes some estimation and some experience to be able to do that. Goodwill is the amount a company is paid to acquire certain favorable intangible attributes of a business. So we go and pay more than the fair market value for a company. And we do that, we're willing to do that because they have market share, they have customers, they have a good reputation for being solid, they have good employees. And so we're willing to pay a premium for that. And we call that goodwill. There are some differences here. I'll let you note these in terms of the international standards and US GAAP and see the differences included there. Patents include an exclusive right granted by the federal government to manufacture, use, and sell a particular product. The purpose of this grant is to encourage the invention of new products and processes. So we say if you invented something, you should be able to protect it for a period of time from others. Patents are granted for 20 years. The period of amortization should not extend beyond that period. So any cost either to purchase it or defend it in court is included as a patent intangible asset. So longest would be 20 years, but sometimes it's going to be much shorter than that because it might not have market value into the future. So let's assume we purchase a patent from an inventor. It costs $100,000, and 5 years of legal life remain. Originally had 20, so now we have 15 years. So we're going to take that 15 years and consider it. But the estimated useful life is only 8 years. And so we're going to take the shorter of the two periods, take 100,000, divide by 8, and we'll get 12,500 per period. All right, trademark or brand names. Coca-Cola's famous name is a classic example. Trademark is a name, a symbol, or a design, and it allows us to use that, and it is given to us by the federal government as a right. The cost of developing a trademark or brand name often consists of advertising campaigns. Hey, as we advertise, that's an expense. But if the trademark or brand name is purchased, that cost might be substantial. And if that cost is capitalized as an intangible asset, then it's going to be expensed as it is used up. So you can notice here, hey, if we just developed it in an advertising campaign, that's expense. But if we go and purchase it externally, then we can write it up, capitalize it as an asset, and then amortize it to amortization expense over time. Franchises, a similar good example would be McDonald's. They franchise, it gives you a right to operate in a specific region, and that is a right granted by the company. And so that's an example of an intangible. You can't touch it, but it does have value. When the cost of franchise is small, it can maybe charge immediately to expense. But if it is large and material, meaning it might make a difference in the decision, it is going to be amortized over the life of the franchise. And so you could think of that. Another intangible would be copyrights. So copyrights gives an exclusive right granted by the federal government to protect the production and sale of literary or artistic materials. The cost of obtaining a copyright might be minor, and so that could just be expense, not material. But say we go out and purchase that copyright from someone else, okay, then we're going to capitalize it as an asset and amortize it over its useful life. All right, the next one we want to talk about is R&D costs. And so R&D costs suggest we're going to be creating new products and we're going to spend billions of dollars. Well, the rule is that R&D expenditures are expensed immediately. And we could talk more about why that is, but that is the rule and that's consistent with GAAP. So you're working as an equity analyst at Wall Street, and a college intern asks you to explain why companies can differ greatly in the R&D expense to net sales ratio. Well, some spend more on R&D. It's important to them to create new products, and so they're going to spend more and more on that. Or others don't have that same need or don't have that same business model. The next one we want to talk about is the third type of asset, and that would be natural resources. So we might have mining, we might have mineral rights, oil, gas reserve, tracts of timber. See, these are natural resources, and we want to figure out how to account for those. Okay, so theoretically, a coal mine might be regarded as an underground inventory of coal. However, such an inventory is certainly not a current asset. It's underground. Hey, are you going to be able to get it and sell it immediately? Probably not. And so it's going to be a long-term asset. And once the coal is removed, it's going to be included as inventory, okay, and it's ready to be sold, okay? But if we bought some property and whatever the cost of that property would be classified as property, plant, equipment. So you can see how that looks like. So depletion is like depreciation. It just says it is being used up. It's being depleted. It is going away. So once all the coal has been removed from a coal mine, for example, the mine is fully depleted. And we need to reflect that. And so here's an example. Rainbow Minerals pays $48 million to acquire the mine, and it is believed to have $5 million in coal. The residual value of the mine after all the coal is removed is estimated to be $8 million. Okay, so what's the value? Well, the original cost less its residual value is $40 million. We expect that to give us 5 million tons or $8 per ton. And so if we go and take out 2 million tons, the cost is 8 million. And so we're going to debit inventory, 16 million, and credit accumulated depreciation for that red value mine. Okay, so we acquired it, it got put on the books for 48 million, but now we're depleting it. And so we can see what that looks like there. As the coal is sold, this coal is transferred from inventory to the cost of goods sold, just like a merchandiser, and it's used up. We note that accumulated depletion is a contra asset or will reduce that asset.